In 2008, the global economy took its most brutal hit since the Great Depression. Nearly $19 trillion in household wealth evaporated, the stock market was cut in half, and unemployment soared to 10%, and the fuse that set it all off, buying houses. In early 21st century America, getting a mortgage was as casual as ordering takeout. You didn't even need a job. As long as you were still breathing, you could get a loan. Then, all of a sudden, the music stopped, and everyone realized the floor beneath their feet had vanished. How did a seemingly booming real estate market nearly drag the entire global economy into the abyss? The story begins in 2000. The dot-com bubble burst, the Nasdaq plummeted, and the US economy cooled rapidly. To pull the economy out of the mire, the Federal Reserve slashed interest rates 11 times in a row, all the way down to 1.75%, a 40-year low. At the same time, the US government ambitiously set out to expand homeownership, pushing legislation that required mortgage giants Fannie Mae and Freddie Mac to purchase more home loans for low-income borrowers. Low interest rates combined with favorable policy tailwinds sent the real estate market skyrocketing as if strapped to a booster rocket. By 2004, the homeownership rate had climbed to a historic peak of 69%. But problems came with it. To keep the mortgage assembly line running non-stop, lending standards were lowered again and again. Lenders began issuing massive volumes of subprime loans to people with abysmal credit or no credit history at all. The most absurd of these were called ninja loans. No income. An unemployed person walks into a bank hoping to borrow a little money for rent and walks out holding a $600,000 mortgage and a new house. By any normal logic, this makes no sense. Yet it happened openly and brazenly. Why did this happen? Because the rules had been gutted. After the Great Depression, the United States had built a rigorous financial regulatory framework to keep banks in line. But over the decades, a shadow banking system operating outside those rules had quietly grown into a behemoth. Investment banks and various unregulated financial institutions were doing exactly the same work as banks, yet no one supervised them, and there was no safety net to catch them if they fell. They gambled with extraordinarily complex financial instruments and massive leverage, and outsiders couldn't begin to understand what was going on inside. In April 2004, things spiraled even further out of control. The Securities and Exchange Commission relaxed its net capital rules. Previously, investment banks' leverage ratios had been strictly capped at 12 to -1. Under the new rules, investment banks with over $5 billion in assets could lever up as much as they pleased with no ceiling. Regulators at the time believed these large banks understood their own risks better than any rulebook could dictate. It was a miscalculation of staggering cost. In reality, the banks didn't care about risk at all, for one simple reason: the loans never stayed on their own books. They were running an assembly line, bundling loans into mortgage-backed securities and collateralized debt obligations, or CDOs, then flipping them to investors around the world. As for the quality of these products, well, credit rating agencies were there to vouch for them. But here's the irony. The rating agencies' fees were paid by the very investment banks manufacturing the CDOs. When the referee's salary is paid by the players, can the game really be fair? And so piles of what were essentially junk loan packages were stamped with the gold standard seal of AAA, the highest credit rating. Wall Street was completely intoxicated by the fee bonanza. Subprime lenders churned out loans relentlessly. Investment banks packaged and resold them feverishly, and global investors snapped them up frantically. Every link in the chain was making money, and nobody wanted to stop. The underlying logic of this game was, if you slice risk into small enough pieces and scatter them far enough, risk ceases to exist. But reality was an entirely different story. If you tear a bag of garbage into 100 pieces and hide them in 100 different corners, the garbage doesn't disappear. It just takes longer for the stench to seep out. And when the garbage accumulates past a tipping point, the entire street reeks of rot. By 2005. The real estate frenzy had reached its absolute crescendo. Subprime loans had ballooned to nearly 20% of all new mortgage originations. A product called the interest-only mortgage became wildly popular. Borrowers paid only interest at the start, with no principal repayment, essentially spending tomorrow's money today. Meanwhile, global capital ravenously devoured any financial product remotely connected to us real estate, because American real estate had long been regarded as one of the safest assets in the world. On the surface, this money machine appeared to run forever, but beneath the ice, cracks were already silently spreading. In 2006, an ominous signal appeared. The U.S. Treasury yield curve inverted, a textbook recession warning. The few clear-headed voices on Wall Street began sounding alarms, insisting this real estate feast couldn't last forever. Sure enough, in 2007, home prices peaked and turned downward. Millions of borrowers suddenly realized they couldn't make their payments, and default rates surged. The mortgage-backed securities and CDOs that had once been traded like hot commodities were exposed for what they truly were, far less safe than the houses themselves. Banks, insurance companies, and pension funds holding tens or even hundreds of billions of dollars in these assets began hemorrhaging. In the first half of 2007, amid a torrent of defaults and foreclosures, more than 20 subprime lenders collapsed one after another, including industry bellwether New Century Financial. By mid-year, two Bear Stearns hedge funds heavily invested in the mortgage market imploded, sending shockwaves instantly across Wall Street. A shocking figure surfaced: subprime loans accounted for only 13% of all mortgages. Yet they represented nearly half of all foreclosure cases. Panic spread like wildfire, and the credit markets descended into chaos. Bear Stearns froze redemptions from its funds. Banks refused to lend to one another because nobody knew how many landmines were buried on the other side's balance sheet. The Federal Reserve urgently cut rates and injected massive amounts of cash into the market, desperately trying to keep the financial system's blood flowing. But it was far from enough. In early 2008, the real estate collapse detonated in full. Roughly a quarter of all subprime mortgages went into default. Millions of homeowners found themselves underwater, owing more to the bank than their homes were worth. In March, Bear Stearns, one of Wall Street's oldest investment banks, teetered on the brink. In a life or death moment, the Fed brokered a fire sale deal. JP Morgan Chase acquired Bear Stearns for just $2 per share, later raised to $10, with the federal government providing $30 billion in guarantees to back the transaction. The crisis continued to worsen. On the 6th of September, the U.S. government was forced to seize control of Fannie Mae and Freddie Mac. These two institutions backed roughly half of all home loans in the country and had slid to the edge of insolvency. The government had no choice but to step in directly to prevent an even larger chain reaction collapse. Yet the darkest hour was still ahead. On the 15th of September 2008, Lehman Brothers, with 158 years of history, declared bankruptcy after drowning in toxic mortgage assets and being denied a government bailout. Just one day later, insurance giant AIG, crippled by catastrophic losses on mortgage-related products and on the verge of total collapse, received an $85 billion emergency lifeline from the Federal Reserve. By this point, the credit markets had frozen completely, and the entire financial system hung on the edge of a cliff, ready to plunge at any moment. At this critical juncture, as the financial world was in freefall, Congress passed the $700 billion Troubled Asset Relief Program at breathtaking speed in early October. It was both a last-ditch effort to stabilize the banking system and a cold declaration of fact. The global economy was just one step away from total collapse. The wave of destruction poured out of Wall Street and rapidly engulfed every corner of the real economy. By October, the Dow Jones had plunged nearly 40% from its peak. Credit dried up completely, and full-blown financial panic swept across the globe. The scenes in trading rooms were the stuff of nightmares. London called asking about a $2 billion credit default swap exposure, and the people in New York opened their books only to discover that CDOs, squads, and synthetic mezzanine products made up 90% of the firm's assets, all of which had gone to zero. A building that had looked rock solid turned out to have every last rebar in its foundation rusted through. The crisis was born on Wall Street, but its destructive force reached far beyond. Approximately 4 million American families lost their homes. Another 4.5 million were mired in foreclosure or delinquency. About 8.7 million people lost their jobs, and unemployment climbed to 10%. Across the Atlantic, the carnage was equally devastating. European banks that had gorged on American mortgage-backed securities teetered on the brink, and Iceland's entire banking system collapsed overnight. Global stock markets were a sea of misery, with many falling 40 to 60% from their highs. In 2009, global trade shrank by nearly 10%. A subprime crisis that originated in American suburban homes ultimately became an economic storm that swept the entire world. What lessons did this disaster leave behind? First, freedom without guardrails is danger. Banks and investors bet everything on complex products they didn't even fully understand. Second, the gatekeepers crumbled first. Credit rating agencies, paid by the banks themselves, slapped the highest ratings on toxic assets and grossly underestimated the possibility of mass defaults. Third, the stewards of monetary policy made grave errors. Greenspan maintained excessively low interest rates for too long, blindly trusting that banks could regulate themselves, fueling the bubble without ever tapping the brakes. Fourth, and most profoundly, complexity does not equal safety. Wall Street designed sophisticated risk models, yet fatally underestimated how interconnected everything was. When the real estate domino fell, the entire global financial system shook with it. The collapse of Lehman Brothers wasn't the end of one company. it was the first domino to topple. After the crash, the U.S. government and the Federal Reserve launched an unprecedented rescue. The $700 billion TARP injected capital into institutions on the brink, stabilizing the system, but also igniting public fury. Taxpayer money was being used to save the very companies that had engineered the disaster, and moral hazard became a buzzword on every street corner. Yet policymakers had to accomplish two things simultaneously: restart the economy and rebuild the system. The Fed cut interest rates to near zero. Obama signed a $787 billion stimulus package. In 2010, Congress passed the Dodd-Frank Act, the most comprehensive financial regulatory overhaul in decades, requiring banks to undergo regular stress tests, establishing the Consumer Financial Protection Bureau, and introducing the Volcker Rule to prohibit banks from using depositors' money for speculative trading. Everything pointed toward a single goal, ensuring 2008 would never happen again. On the international stage, regulators across nations joined forces to introduce Basel III, requiring banks to hold larger capital buffers. The economy recovered slowly, but the wounds lingered for years. The Great Recession technically ended in June 2009, but for ordinary Americans, the pain was only cutting deeper into the bone. Unemployment remained stubbornly high for years. Home prices and household incomes didn't claw back to pre-crisis levels until the mid-2010s, and the stock market took a full 6 years to return to its 2007 highs. Foreclosed homes, vanished jobs, shattered trust. The scars of 2008 continued to ache long after the crisis was declared over. Looking back at this catastrophe, it wasn't caused by a few greedy bankers or unlucky homeowners. It was the collective failure of an entire system. A house of cards built on shoddy loans, blind trust, absent regulation, and the illusion that home prices only go up. Wall Street's brightest minds believed they had tamed risk, when in truth they had merely buried it underground, assuming that what you can't see doesn't exist. Financial innovation is not inherently sinful, but when you can't even understand what you are holding in your own hands, danger has already arrived. Remember one simple truth: if something is so sophisticated that it looks like it can never go wrong, it is usually also so sophisticated that by the time it does go wrong, you won't have time to react. If you found this insightful, hit subscribe, and next time we'll continue breaking down the real stories hidden behind the numbers.